Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, July 1st, 2016. We have quite a bit to cover this week, but basically stocks erased the Brexit plunge, and I think the evidence is still firmly bullish. We look at some of the defensive sectors that hit all-time highs this week, and even the riskier sectors are close to hitting 52-week highs. We look at one of the sectors in one country. Bonds also hit all-time highs, but I honestly wouldn't chase them at these prices up here. Then we'll look at currencies, where dollar gained slightly against other currencies. We'll look at pound and yen, which I think both are ready for a reversal. Look at gold and GDX as they push higher, and look at a couple of commodities that I normally cover that are gaining this week, and we'll also look at a couple of soft commodities, agricultural ones that are going the opposite routes this week. So I usually open with a daily chart, but I think this week I'll open with a weekly chart, and this is S&P 500 total return index with dividends included. So this week's candle really speaks volumes about this market, and I think this market has been quite resilient. We had 3 weeks of falling, and then one enormous looking weekly candle, which basically erases all of these 3 weeks of losses, and we're again approaching all-time highs. You can say that this is a bullish engulfing because the real body of the candle is engulfing the previous real body of the candle. So a breakout above this pattern will certainly indicate that we're going to go higher from here. Anything is possible, of course. We could kind of go sideways and maybe drop some, but I think the overall direction of the market is still firmly up. And here is the chart I usually open with. This is S&P 500 with dividends included. And here's the Brexit plunge. We opened here, and then we plunged with a gap down and continued lower. And then the next day we had another foray into negative territory and broke this support. Now this to me looks like a bear trap right now, unless of course we reverse and head lower, which is also possible. I'm not excluding this possibility. But for now this looks like a bear trap with a plunge below the support here, and an immediate reversal with a strong candle next day and a gap up here the day after, and continuation higher. Now you can see that we already are seeing some tails out of the top here on Friday, so it's a possibility we are seeing some profit taken from maybe people who bought down here, which is absolutely fine. I think again the general direction is higher from here. There's ITBM, I pointed this out last week, have not had a foray into negative territory just yet, and we don't know if it will. I mean, we could just continue sideways and higher. I had plenty of historical examples where the oscillators kind of try to go into negative territory, but then they just don't, and they just continue higher because stocks generally have a bullish bias to them, especially currently with the non-stop interference from the central banks in the other countries. Then there's lots of money being printed, and it finds its way into the stock market. This is a chart of S&P 500, the underlying index without the dividends. It's a longer term chart, about a year worth of data here. So here we have upper part here, it's my proprietary market breadth index that called entry into the bear market here in September of last year, and then this whole rally I considered a bear market rally, and then we actually shorted it with my subscribers here. This rally up to this point here I consider still a bear market rally, but then the evidence shifted, and this indicator now is firmly in the bullish territory, and basically I'm looking for any kind of buying opportunities within a bigger uptrend right now. In fact, let's look at the next chart. Here's the next chart, and this is the same market breadth index here. but this is going back to 1996. So I already showed this chart several times in the past. You can look at my previous videos, but it attempts to call a bear or a bull market in S&P 500, and it did a pretty good job of it here in 2001, 2003 bear market here, and then we had a bull market here in 2003, 2008, and then another bear market and another bull market. Notice that here in 2010, 2012, there was no entry into a new bear market because this index did not drop into the bearish territory. So these were simple, corrections, so to speak, within a bigger uptrend. Up here we had a entry into a bear market, but now we have, interference from the central bankers. So basically, for now, this bear market has been averted, I think. Again, anything is possible, and we can still see a reversal in this index, and we can continue lower. But I think for now, the evidence is still bullish. Of course, I'm monitoring this on a daily basis, but as of right now, again, I think that the evidence is bullish, and I will look for only buying opportunities. This is New York Stock Exchange Composite Index. It's clearly a weaker index because it includes a lot of the small and mid-cap stocks as opposed to S&P 500, which has more of the large-cap stocks in it. But nevertheless, the important thing on this chart I wanted to show is this index here. This is new highs divided by, this is new highs less new lows divided by total active symbols. And if you're a conservative investor and you want to have a lot of proof on your side that we are in a bull or a bear market, then this is one of those indicators. And you can simply set a relatively tough trigger. So for example, here what I did is I set a trigger where if we hit negative 10% on this indicator, in other words, the new highs are outnumbered by new lows by more than 10% here, we are going to consider that this is a bear market. And this is where it happened. It happened here sometime in July of last year. Now the opposite just happened, and we had a bullish trigger here just the day before, actually on Thursday. So even if you're very conservative, I think this already is speaking volumes. And in other words, we are now outnumbering, the new highs are now outnumbering new lows significantly, and it had happened already for a few months. So I think that now even more evidence is shifting into the bullish camp. Of course, again, anything is possible, and we could reverse down. But I think my bias is to the upside, and I think the bigger moves will come to the upside from here on. Some of the sectors that hit all-time highs here during this week, and in fact Friday, are utilities, of course. I think this is more to do with the strength in bonds than strength in the stock market. But utilities are kind of in between. They also have a somewhat higher correlation to the bond market versus the S&P 500. So additionally to the pressure from the stock market, utilities are also part of the stock market. They're also being pressured higher by the low interest rates. So utilities are certainly the beneficiaries of this move higher. Another defensive sector is XLP, the consumer staples, also hit all-time highs just on Friday. So another is a United States real estate, REITs, also hit all-time highs on Friday. And again, real estate is more dependent on the interest rates than the rest of the stock market. But this is sort of indicative that we have, general pressure higher for stocks. But then you will ask a question, all of the previous three sectors, aren't they defensive in nature? And of course you will be correct, they are defensive in nature, they are still stocks, they are part of the market though. So here's another sector, and that's industrials, and this is very much an offensive sector. Also a broad sector that includes transportation stocks, which are extremely sensitive to the general market. And they are really approaching all-time highs. This is very close to all-time highs. Now we're at 56.19, the all-time highs at 56.91. So truly we are very close to all-time highs, and even in defensive and in offensive sectors. If you do a Google search in Brazil recession, you'll get a whole bunch of results with Brazil recession, all kinds of doomsday headlines, and it's looking terrible, and it will be the end of the world in Brazil. But if we kind of ignore the news and simply focus on the charts, so let's just look at that and look at this is EWZ, the Brazil ETF. We're really approaching 52-week highs, and the 52-week highs are just a little bit higher. And interesting thing is that Brazil really showed quite resilience during the Brexit. This was the entire Brexit move. It barely registered here. In fact, the subscribers we did I did an alert, and hopefully, if you bought, you're sitting now on nice gains for Brazil. So sometimes the news really scare people and try to sensationalize all kinds of scary scenarios out there. But if you truly just look at the chart, and this was the entire Brexit, so I wouldn't really even consider it a big event here on this chart. And now we're approaching 52-week high, so maybe the Brazil recession is really coming to an end. Anyways, let's move on to bonds. This is TLT, the long treasury bonds. Very strong action. This is all-time highs again, just on Friday, really. We had a breakout here, continuation higher, throwback, and a push higher. I mean, this is really a classic move, but it's sometimes difficult to catch. Like, for example, there was this enormous gap up here, and then another gap up here above this highs here. So it's pretty wild action. Sometimes it's difficult to catch every single move, and in fact I kind of gave up on that. I just try to catch as many moves as I can, and some moves you just cannot catch, and that's okay. So anyways, bullish action on bonds. I think they're a bit overextended, but then again I was saying the same thing here, so maybe we'll get a pullback of some sort, and then yet another push higher. So for now, I'm looking at this from purely bullish perspective, purely on the long side. Here is a TLT and weekly time frame. A little bit more clear picture. This is all-time highs here again, with an enormous gap here. Well, not enormous, a relatively large gap here. Now, here's where it gets a little interesting. So we have a possibly looks like a cup pattern, and this pattern is 6.1% deep. So let me do a quick measuring tool, and we are kind of getting there. So a 6% move would put a TLT at 142.55, and we're pretty much almost there. So maybe TLT moves up a little bit more, but then the depth of this pattern would come into play, and maybe we'll see some selling. Now we have an even deeper pattern here, which is just enormous cup and handle here with a depth of 20%. It's possible that we'll just continue higher, but I think this pattern may play out if we see some sort of an Armageddon scenario, and I just don't see it right now. This is a more broad AGG, broadly diversified bonds. Also similar patterns, but not as abrupt and not as strong as the TLT. So we have another gap here and another gap here, yet another gap here. So we just kind of pushed higher and higher and higher. And this move is really overextended. I would not chase it up here under any circumstances. We do have a position open. I do have a position open, but I opened it way back here. So I just kind of keeping it open and looking for dividends to roll in. Here's what gets really interesting, and this is AGG on the weekly time frame. So I think this pattern now is basically complete. So we have duplicated the depth of this pattern on the upside. So yeah, looks like we may be ready for some sort of a corrective action. Now, this could take two ways. It could be a price correction, we actually drop in price. It could also mean time correction, we simply trade sideways, which both are quite possible. Maybe a combination of both. So with bonds, certainly a strong move, but I would not chase it up here under any circumstances. And I do have a position open, but from way back in 2015. And I'll be just waiting for either new opportunities to buy bonds or simply just hold on to what I have right now. All right, moving on to the currency universe. This is US dollar index, daily time frame. Of course, as a result of Brexit, we had the dollar gain strongly. Here's the big candlestick here, and then we're kind of correcting maybe as a falling flag. This is a bullish pattern. I think here we had a bear trap and then continued higher. This is continuation higher, throwback, continuation higher, another throwback, and then support was held here. And then we continued higher. So I think the dollar itself is bullish. As far as what is it bullish against, I think the euro may continue lower. And then also the yen. We'll talk about the yen more a little bit later, but I think it's hitting 52-week highs, so it's certainly overextended here, I think. And then pound, we are at 30+ year lows, so I'll also discuss pound a little bit later, but I think it's really overextended to the downside. Here is the US dollar in the weekly time frame. Nothing really changed much from last week. I extended this trend line last week here, and we're sort of still hitting that trend line on a weekly time frame. All right, and here is the British pound versus the US dollar. In fact, I'm gonna get rid of this volume here. There's no volume in Forex here. So very overextended to the downside. I think if this is the maybe a cup, this is about 9%. We basically completed the target on the downside. So I think some sort of a corrective pattern, maybe a bounce to 1.38 is indeed possible, possibly even higher. But I did get, I read the news that Bank of England is considering a rate cut in the summer, so maybe a bounce higher, and then once the rate is announced, we're going to see another leg lower. Generally speaking, this is quite a bearish chart, and these are 30+ year lows. This is yen, and the yen is sort of the opposite. So this is US dollar versus the Japanese yen. So if you trade Forex, that means that the yen is winning in this battle, and it's going lower. But this is US dollar versus Japanese yen. So here we kind of touched this lows here. This is a multi-year low, 2+ year lows, but so far we failed to close below this level at 174. So we kind of pierced through them, but so far we failed to close below those levels. Next chart actually is a little bit more clear, and this is Japanese yen. Here we're getting close to 2-year highs. So Strong yen is bad for Japanese exporters, and Bank of Japan repeatedly indicated that they will intervene, at a certain point in the future if yen gets too expensive, which is kind of crazy in my opinion that yen is getting very expensive because they have a continuing quantitative easing program that just prints a lot of yens, and yet it's getting more expensive. And this is because of the perceived safe haven status of the yen. But we can kind of see the resistance level here in this area of 98 from this trading range here from 2014, and we're approaching highs set in 2014. So I would not be surprised if yen kind of bounces around and maybe reverses from here lower, especially if Bank of Japan decides to intervene. If yen reverses, this will certainly help the dollar. As a result of all of this turmoil in the currency market, gold has been gaining in price. This is 52-week highs again here. I'll move the sign here soon. I thought this was the climactic volume here, and it's still possible that this is indeed a climactic volume. So there's going to be a lot of resistance up here at 1360, especially if I'm correct and the yen uh, goes down from here versus the dollar, and maybe the euro starts dropping more, and maybe potentially the British pound will drop from here as well, then that by extension would imply that the dollar is gaining. Dollar strength is bad for gold because it's traded on the forex as XAU/USD. So in other words, if the United States dollar strengthens, this will weigh on gold. For now, honestly, I'm staying away out of this market because it's a bit too crazy right now. As far as GDX, now this is GDX, the gold miners ETF. It also hit 52-week highs. For the record, I think that this is a bullish chart, and I think gold is in a new bull market, but it is overextended. From this chart, I wanted to show that, first of all, we gapped up to 52-week highs, so this could be an exhaustion gap. It's possible that this is an exhaustion gap, and we will drop from here. We are also extremely overbought. This is a gold miners bullish percent index. It's currently at 100. So in other words, every single miner within the GDX is currently on the point and figure buy signal. This is very overbought in my opinion. This is also well over 100% move from 12.40 down here to $29. So even if you don't know anything about stocks, you would probably think that this is quite overextended. Now, overbought securities can remain overbought for prolonged periods of time, so I'm not going to say that this is indeed the top. And in fact, I would not even consider shorting this security right now. But as I said before, if we get a further strength in the dollar, it will eventually weigh on gold and by extension gold miners. All right, and here is light crude oil, West Texas Intermediate. So we kind of had a strong rally here from the February lows, and then we hit this resistance here from these peaks here from February 2015 peaks, and from the attempted run up here in September, October of last year. And I think resistance is still reaffirmed, but this week this could be a hammer candlestick, and it's possible that we're going to continue higher. It is indeed possible that that will happen. Generally speaking, for now, I'm treating this still as a bearish security until we get a higher low. And to get a higher high rather, until we get a higher high, we probably need a breakout above this level at the very least, preferably above the $60 level better. For now, I'm still treating it as bearish security, and I'm looking for shorting opportunities. This is natural gas on a daily time frame. These are 52-week highs. really strong move from multi-year lows to 52-week highs. We had some indecisive action here, then we finally broke out above this level here at $2.30 and continued higher. We also took out this major resistance zone at $2.50 that I pointed out numerous occasions in the past, and then continued higher. I'm treating this very much as a bullish security. Once we get some sort of a pullback, I'll be certainly looking to enter on the long side. Here is a natural gas on a weekly time frame, and here's that resistance at $2.50 that I pointed out. And this resistance was really strong. It had many touches here in the $2.50 area, and then a breakdown below this level, an attempted rally that failed, and then finally a breakout. So, kind of overextended, I think, in my opinion, but a pullback of some sort and a corrective action maybe will provide for a better entry on the long side. And we'll move on to some of the soft commodities. These are soybeans, continuous contract. This is a weekly time frame. We had a nice big breakout here. There are multiple ways of looking at it. You can say that this was a breakout above these levels here. It just depends how you look at things. But the thing is, like, for example, here we had also what appeared to be a breakout, and then it completely unraveled. So this clearly is a breakout, and these are 52-week highs. So now soybeans are certainly looking bullish, and a corrective action would offer a nice entry opportunity for soybeans. One of the other soft commodities I was looking at, and this actually brings me to my previous point, where there appears to be a breakout, but then it kind of unravels. And like, for example, here with another breakout with a strong candle, continuation higher, completely unraveled and then continued lower. And these are multi-year lows for wheat. These are weekly time frame as well. So I don't see any breakouts, obviously, but I do see a breakdown, so I see a continuation lower for wheat still. So, not every single breakout will hold, but the one in soybeans is certainly looking good. All right, that's it for this week's recap. Thanks for watching, and please stay tuned on how to find us on the internet. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the success as in trading. There's quite a bit of psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members, so that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.